Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers. For today's episode 112, we're going to continue our discussion on the basics of trust situs. And this will be part 2 in this series where we're going to talk about the income tax situs of trusts. Now, this is a bit of a difficult topic to tackle, as I saw and mentioned in the introductory discussion for this series. So as you're going to see, we're going to scratch the surface and really just kind of give you the tools to look at in whatever state or states you might be dealing with. Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So, as with my previous episode on trust situs, the goal was not to help you draw conclusions, but to help you create a map for yourself to determine trust situs or situses, as we're going to see when it comes to income tax, and reach those conclusions yourself. So this is a highly unsettled area. There's been a lot of activity in some states, and in other states there's been a shocking degree of inactivity here. But, as we're going to see, it's possible that a trust could have multiple situses from an income tax perspective. And with revenues being down, especially post-COVID, I would venture to guess that this is going to become a hot button issue in many places, as it already has been before COVID with some select states. Now, what we're not going to get into is any sort of foreign situs to a trust. We're only concerned today with the domestic trusts that are administered in a U.S. state, and we're only going to really look to state income tax with respect to a trust. So, as I mentioned, when it comes to trust situs, there may not be one dominant situs. Multiple states could ultimately be in play. So, it's helpful, first off, when you're looking at the multiple situses and potential conflicts between them to determine whether one or more of those situs states even has an income tax. And if not, then there might be no trust level income tax in those states, but a beneficiary's share of trust income, whether distributed or undistributed, could ultimately be taxed to that beneficiary in their state of domicile. So this is the point lost with a lot of the nings and dings and other types of trusts that are designed to leverage no income tax state situses, is that any income that's actually distributed to a beneficiary still will be subject to income tax. And I won't get into throwback rules and everything like that, just because those add a wrinkle that takes well beyond our time allotted here. But I also want to mention too that there could be credits between states that may wash out some of the tax liability when it comes to states that are treated as, or trusts that are treated as a resident of multiple states. But you should familiarize yourself with whether those credits exist, and if so, what are the calculations for them. Then finally, even if your tax is zeroed out ultimately, you should be aware of the mere filing requirement for each state, because failure to file penalties could be severe depending on which state you're dealing with, even though there might be no tax liability upon which the penalties could be calculated, as you might see at a federal level. Different states may assess penalties in a different fashion. So you still might have to go to the expense of filing a zero tax income tax return if a trust can be quote-unquote sitused in a certain state. Now, the factors are endless for determining income tax situs. Facts and circumstances really kind of depend, and when it gets into the nuances here, what we're not going to dig into is how do you define administered in a state? What's the level of activity that a trust has to rise to be administered in a particular state? Just because there's such a wide variance that it's impossible to do that subject justice, and there's such a lack of guidance. For example, in Colorado where I practice, a resident trust is defined as a trust administered in Colorado, with no guidance as to what administered actually means, outside of maybe looking to the Uniform Trust Code. But first off, you need to look, where is your fiduciary located? if a fiduciary is domiciled in a particular state, and whether or not they conduct some or all activities of administering the trust in that state may be treated as the situs and may be able to sink its claws into the income of that trust. So, depending on the state, there may be a nod to a corporate trustee over an individual trustee. That's more of a uniform trust code type of analysis, but it's also important to note that that fiduciary concept could capture trust advisor roles, such as a trust protector, trust advisor, so on and so forth, even if that role is not a fiduciary role. It could be enough to create a connection to that state. Now, obviously, if a trust is created by a resident of a state during life or at death, that's going to be kind of the first layer of analysis beyond the fiduciary location to look to, especially if no activity has ever occurred to move the situs of that trust from that state. Another issue could be if a trust has income sourced from a particular state. Then, even if that trust is a non-resident trust, that source income could be taxed to the trust and or its beneficiaries. Then, we get into the bigger issue: where are beneficiaries located? Now, as I mentioned in a previous episode, the recent Supreme Court case, U.S. Supreme Court case of Kaestner, deemed it unconstitutional to tax a trust merely based on the fact that a beneficiary is located in a particular state. But from there, that doesn't necessarily mean you can't look to the beneficiary. Really, it becomes a matter of kind of looking at what income rights does a beneficiary have, and I could see that, with a mandatory income distribution, a state could say that the beneficiary or the trust should be taxed, even if that income is not actually distributed. Now, depending on where you're at, there may be apportionment between beneficiaries and fiduciaries both within and without that state. Now, I mentioned California here as a particular example of that, but the mere right to discretionary income could also be a factor because, non-contingent beneficiaries tend to be ignored in this analysis. But when it comes to discretionary income, I could also see the Kaestner analysis creeping in to maybe deem that unconstitutional, depending on what level of income the beneficiary could be entitled to. And that's where, as I mentioned in the calculation types of decisions in a previous episode, you may have to come in and calculate out what is the income interest actuarially for each beneficiary within that trust itself, assuming the maximum access to the income. Now, once you know kind of where your situs state or states might be, you also need to balance between all of those states the various deductions, rates, and credits. Now, states often recognize a deduction for fiduciary income that's distributed to a non-resident beneficiary, similar to the federal D&I deduction. So that may take some income out of the taxation in that particular state. But you may also need to note the character of income as well. Now, that usually doesn't matter at the state level because a lot of states have a flat income tax rate for all sorts of income, but in some cases the character of income could be relevant. I cite Tennessee and New Hampshire as states where they look really just to the income and dividend or the interest and dividend income of a trust when it comes to taxation. It's also important to look: are there any pass-through entities? The income from a pass-through entity that's in a state may be source income for that state, even if the trust is not administered there. But you may want to check because some states kind of look at the pass-through entity interest and assess the passivity. In other words, they might treat it as personal property based on material participation, and that might take away that source income claim of the state in which that passive entity does business. And then finally, if two or more states tax the same items of income, you may have the ability to claim some sort of credit depending on the state. Now, I'm just going to cite the Colorado calculation here, but this isn't necessarily the general rule across the board. I just give this as a numerical example. So let's assume there's $100,000 of income. Maybe it's subject to a 10% tax in state 1 and a 5% tax in state 2. So here you have $15,000 in taxes on the same income, and there's no double tax. There's no ordering where you can say, hey, take out state one's income tax first, and then the 5% only applies to the remaining 90,000. No, you have the same competing rates on the same amount of income with no offset. But in this case, state 2 might give a credit. So let's say state 2 generates a $5,000 tax liability. You might get a credit based on the proportionality of the rates. So in this case, you might take the state 1 rate of 10% divided by the sum of rates between the two states, which is 15%. That would give you a 2/3 ratio. So there would be a tax credit in this case of 2/3 of $5,000, or $3,300 and change in state 1. So that's just a brief example of a possible calculation, but not necessarily the rule everywhere. But as I mentioned, it's hard to nail down what is the rule in all 50 states. You need to know what the rule is in each state that the trust might touch. And you can end up with a lot of resources you need to look to. Luckily, there's a lot of charts out there with Steve Oceans puts out a non-grantor trust chart every year, and there's a variety of other resources to look to get a quick summary of the law based on where you might be at. Now, as always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thank you for listening to this episode of The 10th of an Hour, and I look forward to seeing you in the next one.